We will get started here, folks. We've got a really special session. We haven't had the opportunity in quite some time to have one of our favorite presenters who you're going to be sharing the screen with and hearing from here specifically. It's Ari Karen, who is a partner with Mitchell Sandler, has been with that association for many years. Ari, as many of you may know from seeing him either through us or at other presentations, he goes to a lot of conferences and conventions as a presenter as well. He is the head of litigation, labor, and employment at Mitchell Sandler. He has four kind of primary focus areas: regulatory compliance, which we're going to touch on a little bit today, litigation and enforcement, labor and employment, and then certainly mortgage regulatory. And we're going to be talking a lot in the mortgage space here today as well. So just to give you a little bit more information about Ari as well, in terms of his biography, he represents businesses and financial institutions in litigation matters. He's also involved in government investigations, and he advises clients on regulatory compliance matters. He's widely praised for his business-friendly style of representation. It combines his aggressive advocacy with a sensitivity to practice business considerations. And Ari's approach looks at the impacts of the legal strategy in real estate scenarios, and he allows his clients to remain both compliant and competitive. His practice is very diverse, as we had just mentioned. He covers many subject matters, including banking regulations, consumer protection regulations, Dodd-Frank financial reform laws, which he's become very, very knowledgeable about, and we'll share a little bit about that as well today on some of his comments. He deals with contractual disputes, employment and labor statutes, wage hour class actions, employment discrimination, fair lending matters, whistleblower complaints, and non-competition complaints. Ari litigates before state and federal trial and appellate courts nationwide. He's won precedent-setting decisions against the United States Equal Employment Opportunity Commission, and he's also counseled mortgage banks and financial service firms on their development of cutting-edge employment policies and procedures, as well as developing creative and compliant business strategies for his customers. These procedures have allowed institutions to solve legal and regulatory challenges without disrupting proven business models or undermining competitive advantages. As I said at the start, we are so pleased to have Ari join us here and give us an update. He's going to go a little bit deep here on some of these items, specific to regulation, Dodd-Frank, CFPB. So we've got a lot to cover. We've got plenty of time for him to do that. As always, folks, we have the chat open if you want to add questions in there. And when Ari's finished with his overall presentation, we can move to the chat and hopefully answer any of the questions that you folks may post in there. So with that, Ari, pleasure to have you back. Welcome to New York again, and please, it's all yours.
Thank you. Thank you for having me. I appreciate it. If you want to jump to the first slide, we can kind of, jump into this. I want to kind of give you a high-level overview of what I'm talking about and sort of make some sense of the title about being caught in the middle. I think what's going on these days is a little bit about be careful what you wish for. And what I mean by that is one thing I've noticed from a lot of clients is there's a lot of happiness associated with the fact that there's been a level of deregulation, is sort of an end, at least temporarily, to enforcement or regulation by enforcement, and that's certainly the good part of it. The bad part of it, I think, to some extent, is that with the CFPB, as we all know, sort of stepping back as they have, there is a little bit of a vacuum. And the result is that, while states have filled in to some extent, I don't know they fill in completely, right? And they're still figuring things out because obviously these aren't areas where they've been really involved for a long time. It's been the CFPB. Even through Trump 1, the CFPB continued some of the enforcement. I mean, again, it stepped back, but not to the extent it is now, basically. And so, with that being the case, there is this vacuum, and I think what's happened for a lot of companies is they're sort of caught in this, difficult choice, which is they see some competitors getting very, very aggressive on things, and they're trying to sort of remain competitive, but at the same time recognizing that, well, if I do all the things they're doing, the downside is that, this pendulum will swing back. It always does. Is it in a year? Is it in 2 years or 3 years? Like, nobody obviously knows that answer. But whenever that does swing back, we've seen it from Trump 1 to Biden, where the same thing somebody did in Trump 1 comes back to haunt them later, right? So I can give you a real life example about a client that, obviously I'm not going to use names, but they had a fair lending examination under Trump 1 where they were cleared and there were no required actions to be taken. And then Biden's administration comes in, they get another exam, and there's a potential complaint coming down the pike that we had to deal with simply on the very same things. I mean, the very exact same things that they had been cleared on Trump 1, right? So, as these administrations change, and change is a constant, certainly in politics, the things you do today can come back to haunt you later. Even the extreme example, when it was actually cleared, take the scenario where no one does anything, you can imagine that anybody, it's an open invitation if you're doing something really wrong, to get in trouble later. And so I think what I have a lot of clients really struggling with, and that's what today's presentation is a little bit about, is, how do we live today in a way that is not going to doom us tomorrow? How do we stay in the middle, right? Where we're still competitive enough, but we're also not becoming the low-hanging fruit for tomorrow. That's the real challenge I think lenders have, and that's what the title was about, being caught in the middle. So with that, let's kind of create some backdrops of things we're seeing and that we're going to talk about a little bit more today. One is these executive orders. Now, as you know, there was a long history of fair lending enforcement, increased fair lending enforcement, expansion of fair lending doctrines, redlining, all that. I mean, again, I don't have to necessarily go through the history. You guys probably know that pretty well. And that's all been reversed but now it's going to play the other way, right? Where you have, these executive orders now prohibiting DEI practices, not only prohibiting, threatening to come after companies that engage in DEI practices. You have the executive orders getting rid of disparate impact, and this is on a federal level. On the other hand, you've got the states. The states have their own laws. The states have their own enforcement. I have more than one client dealing with a fair lending case. And one of the things that we're saying to the government or to these state governments is, well, hold on. If I do what you're saying I need to do, then I may be running afoul of executive orders from the federal government, and now might have a problem with the Department of Justice based on the memorandum that had been put out by Pam Bondi, the Attorney General, and I guess it was February, and that's still out there. So, how do we comply with both? That's something we're going to talk about a little bit today. CFPB, where does that stand? I mean, look, let's be clear. The CFPB is not going away. Unless some massive change happens, from Congress getting all on the same page, which they're not, or the Supreme Court somehow makes a huge change and says, they can just eliminate agencies. You got to remember something. The CFPB is not an executive-based agency. And what I mean by that is the CFPB is not an agency that was created by the executive branch of government. It was created by Congress. So the executive branch, if the executive branch, for example, creates an agency, in theory, at least, the executive branch can get rid of it. Thou who can create can destroy, if you will. But the executive branch didn't create the CFPB. That was an act of Congress. That was a Dodd-Frank. So the executive branch can't just throw out Congress and say, well, I don't care what you say, we're ignoring them. So CFPB isn't going away. You have seen a scaling back. I mean, as an example, we've seen all these enforcement cases that have now been dropped, that were pending. I think 2 more just recently were dropped. So, really what it looks like there, we'll get into that a little more, is there's going to be certain areas you've got to really focus on, but a lot of these are not going to be brought by the CFPB. And, there was a couple of months ago, 67 guidance documents or reviews were rescinded. I will tell you, I've gone through them. I think most of them are honestly symbolic. A lot of things that were kind of out there as interim rules and final rules got passed. things that dealt with disparate impact, which are sort of irrelevant already because of other executive orders. So I don't think there was anything really earth-shattering in those guidance documents. But obviously we also know that that the LO comp rule is under review. What I will tell you is that, and we're going to talk about this, the LO comp rule is not going away. I'm pretty confident of that, and we'll talk about some of the reasons for that too. The Department of Justice again has really taken a step up on redlining orders. The special purpose credit programs availability is greatly going to be limited now, because of the DEI initiatives and how you're going to comply with those. So sort of with that backdrop, we could sort of have the rest of our discussion. Next slide, please. So let's talk about sort of this DEI and what we do now. As we know, we have a lot of companies put these together, right, and already had these because of the requirements of the Biden administration and prior administrations where this was in state governments also requiring this. So what do? I mean, obviously one really simple solution is say, oh, I don't have to do this anymore, so I'm out. There's a couple problems with that, right? If you just get rid of all your DEI programs and say, we don't want these anymore. But think about this from a public integrity perspective, right? Your reputation. If you walk away from it today, but yesterday you said this was very important to you and you said all the right buzzwords, doesn't it look a little disingenuous? Like, in other words, you put out there the policy and it said, oh, it had all the right buzzwords, it said all the right things, and that the DEI was important to you, and diversity and inclusion was important to you and very important to your business, and et cetera. And then today you're like, well, I'm not doing it anymore. Sorry. How do you really, you see there's sort of a disingenuous attitude there, right? What you also have to worry about is, again, you can't forget about tomorrow, because tomorrow, what if this comes back in another administration 2 years from now or 3 years from now, and, oh, DEI is important again? Is it? I mean, because, was, then it wasn't, then it was, you have this inconsistency. So can you really totally reverse it? On the other hand, of course, you've got to worry about, complying with the current law. And if you have something out there that's problematic, but the option of just getting rid of it has some problems there, even if legally you can, and that's putting aside the issues with the states and what states are going to require you to do. Getting rid of it is simple, but not necessarily the best way to go. Now, the other option, which is one that I would suggest, is, most of these DEI initiatives that were put out there actually did have some legitimate business purpose. Let's take an easy one. If you said, well, it's really important for us to hire, diverse loan officers because, we want to be able to service our various communities. Look, from a business perspective, let's just put all the, touchy-feely, good stuff, so to say, right, aside, right? If you I think we all know this, and I'll just use this as an example. If there was a community that, let's say, speaks a different language or, has a different culture, or, if you had I'm just going to make this up. If you had, like a Cambodian community, right? Well, one way to really service that community, like it or, and we all know this, is to have somebody who is a member of that community be a loan officer. They're going to get a lot of business. Right. And this isn't about being touchy-feely or doing the right thing with diversity. This is just business, right? If you have somebody who's in that community, they're going to have a leg up on anybody who's not in that community. And if you have that, diverse community that you want to service, and you can find loan officers to hire within that community, that's a smart business practice. Nobody would disagree with that. So there's two ways to call it, though. One way is to say, well, we're really interested in hiring diverse, blah, 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 right? The other is saying, listen, we want to find, candidates that can service, diverse communities, because we think that will give us, an advantage over our competition who, are going to be not able to service that community as effectively with somebody who understands that unique kind of community like we can. That's not diversity. That's just smart business, right? You see how you can take that same idea and convey it as a business idea or convey it as a diversity idea. I will tell you, most of the diversity, DEI policies that we worked on were ones that had business justifications. There weren't a lot that I dealt with that were just not winners that we're doing because we need to do. Almost all of them had a business justification. And so what I would say is if you have a DEI practice, you really need to, instead of think about just getting rid of it, think about the business justifications, reword it for the business justifications. You should be fine from a DOJ sort of perspective. You still have the policy where if a regulator or a state regulator comes to you and says, hey, what happened to your DEI? It's right here, and you could explain it. And in the future, if you need to reword it again or something like that, it's not like you got rid of it and said, we don't care. You just, changed its look a little bit, and you can change its look a little bit back. So I think, what you have to do is look at your DEI policies, find their real business applications where it makes sense, and explain it in those terms instead of what it might have been before, rather than thinking of just, well, delete. I don't know that that's a good thing. Now, where I think this really does get more challenging is when you get to special purpose credit programs. There are some that I think you can do this with. There are others that might be more difficult. So I'd be very cautious, especially about putting in new special purpose credit programs. Again, evaluate your scenario. I would definitely say on something like that, get counsel involved and talk about it with them. And that's not to say you should get rid of them or not. What I'm saying is you should pay attention to those, because I do think there is some risk at a federal level potentially. One of the, there are also ways that they could not just necessarily be DEI, right? They could be based on, because of the way, the special purpose credit programs don't have to be DEI if there's some broader group. So, you say not just this community, but maybe, people who are of lower income, or, a group that could be inclusive of not just the minority. That might be a way of also thinking about how to do that. But again, I think that's a little bit too specific and deep for this discussion today. And so my suggestion would really be to work with counsel on something like that. Next slide, please. So let's talk a little about LO compensation. I mean, let's first state the stage. We know that LO comp rule was put up for review, and a lot of people started speculating that it might go away. From information, I've gathered, and I'm not saying I have anything special. It's just obviously something I pay a little more attention to than the average person. I am very skeptical that it is going away altogether. Are there potential changes? Yeah, I think there's some potential changes. Now again, none of these changes happened under Trump 1, but I think the same changes that were proposed by various trade groups in Trump 1 have sort of been reasserted again. It's the kind of stuff with like bond loans, things that pertain to competition, matching competition, maybe things with some brokered loans, things like that. I will tell you, I think out of those proposals, the one that is least likely is something involving competition, just because you could see where that could be, where the donut hole could eat up the donut there, right? If you were allowed to lower comp for competition reasons, it sort of does, end a lot of the rule. I don't know what you could enforce after that. It would be very difficult, but maybe there's some way they'll do it. So I think there's certainly the possibility of change. I don't think a complete, elimination of the rules happening. And one of the main reasons also beyond that is kind of the thing I said before about, the executive branch's limitations when Congress passes a law. Dodd-Frank, the regulations for LO comp they were established by the CFPB, but the law itself is actually in TILA. It was a law passed by Congress. The executive branch can't say that's gone now. Now, they can say we're not going to enforce it to some extent, right? The problem you end up with there, though, is in 3 years, what happens if there's a new administration? And they say we are. They go back and they can hit you for it. So, that's something you've got to be very conscious of. So let's talk about what some strategies are, because we do know that there are people that are kind of pushing the boundaries here, right? And I know some clients who are really struggling on how to sort of, remain in the middle, right? Not be that low-hanging fruit in the future, but at the same time, remain competitive. So, let's talk about some things you can do. Assigned revenue branches. Just what assigned revenue branch is, just so we know, is a branch where you have a P&L, but the P, the profit, is based on an assigned revenue. So instead of being actual profit, you could assign a profit for 300 basis points or whatever it is on every loan they get credited for, and then all their expenses come out. So, you could sort of figure out what you think their average gross revenue should be based on historical and sort of just apply that forward. And as long as they kind of stay on their average, you should be okay. Now, you can't adjust it every day, right? But there would be some adjustments over some periods of time as you saw macroeconomic conditions, or even the branch changes in terms of its staff, and so things have to adjust based on the types of loans it's doing. I mean, I think there's some kind of go forward there that you can certainly adjust on. So that's something that I think people are doing a lot of, and I do think is relatively safe. There's also different compensation for different LOs. So in other words, and this is how, look, this has been called pick a pay, which I don't really is not what I'm suggesting. But the way I would explain it is this. There are companies, I know of them, some I represent, where they have a lot of LOs, and those LOs have different business models, much like lawyers in a law firm, right? So you've got, some loan officers who don't try to win on price. They say, I'm the Neiman Marcus of loan officers. I'm going to take care of you. You're going to get the red carpet treatment. I'm going to run over your house and grab everything for you. You're not going to have to do anything to show up and close, but you're going to pay for it. Okay, there's those loan officers, and there's loan officers that say, don't call me. I'm not going to call you back. You're getting the lowest rate. Don't bother me, right? Obviously, I'm giving you some extremes here. The point is that if you have a comp plan for the loan officer that says, hey, I'm the red carpet treatment, and you have another one for the loan officer who says, listen, I'm the Walmart, so to speak, of the loan officer group at this company, and I have a different business model. Can they coexist? And the answer is yes. They don't have to be forced into the middle. I think when you have those different models, you can have comp plans and pricing plans that are relative to that. Again, you've always got to be worried about fair lending and things like that. But you can have those sort of distinctions, right? Now, they can't necessarily pass back and forth to make fun of pricing with each other. That, they can't play those games. But simply having different comp for different strategies and business programs for different LOs, I think is fine, even if the pricing is a little different. So I think, you could do that. I think also, can you have a scenario where you have a legitimate LOA assigned to a loan and you don't? So loan officer works alone on his own loans. And if he wants to have an LOA or she wants to have an LOA work on the loan with her, there's a different comp, assuming, of course, they're actually doing it. We're not talking about, some game with the title. We're saying there's actually a different loan officer assistant helping you because right, if you're doing the whole loan alone, right? Or you have the loan with somebody working with you on it, and that's legitimate. I mean, I think there is a basis for potential distinction there if it's legit. So I think, that could happen. I think, and similarly, when you're talking about legitimately referred loans, and I mean, what I'm talking about is, not only the actual work, but legitimate reasons. So for example, a scenario where you're not licensed in a state, right? Can you refer to another loan officer and have a difference in comp there? I think that's the kind of thing you can do, definitely. Again, now, if it's just a game where you're trying to play, throw it back and forth to each other to kind of, get advantage of pricing and doing all this other stuff, that stuff's going to kind of be clear. And, I don't think that's something you could do. I think some of the gray areas, these are the ones I touch upon. Look, these are areas that I think a lot of people are doing. I can't tell you that technically it's right. I just know it's certainly happening to some extent. And you're going to have to make some real decisions for yourself on these, and I think they're a little bit different. Like with bond loans, look, I think there's some arguments for bond loans, and I think there's a decent chance that maybe the regulations change there. So while technically, I don't think that's something you could distinguish on. I think that to me would be one of the safer gray areas if you had a distinction for bond loans, simply because there's some pretty good arguments for it. I do know that the CFPB was considering it even under when the LO comp was first changed and never was actually effectuated, but there was something there. I think there's also scenarios with bond loans where, depending on the state you're in, you may not have the right training. There may be some specific training that's required, and if people don't have it, how do they do the loan? So I think there's some areas there. quarterly adjustments, quarterly adjustments. Look, I think the rule should be every 6 months, but I also realize, and this is a question of degree, right? If you are adjusting, and this is why I say with discretion, everybody every quarter, to the singular basis point based on what they did, you're going to get in trouble for that, in my opinion. And it's certainly not lawful. But let's say that, there might be a quarter here where you adjust a couple people because there's a whole variety of circumstances and they're just not doing their job right, or somebody to the contrary is doing a fantastic job and you want to reward them. So, I think when it's, as I say, with discretion, or you bring somebody in and they're new, and all of a sudden, they're doing not what you thought they would do, and you want to change it to kind of get them right sized, right, if you will. I think those are the scenarios. So when I say with discretion, I mean, there are times, but if you're trying to get down to like basically back end what they did last month, right, that's on the extreme, that's not going to be okay. And in a similar way as self-sourced versus company sourced. Look, again, there are people doing this. We know there are people doing this wrong. And what I mean by wrong is that it's a charade. It's not real, But if it's done right, if it's done legitimately, then that is permissible to do it that way if it's done legitimately. Now, where it's just a game with the title, that's not going to be okay. So how do you distinguish these two? A game versus something legitimate? Well, for one, when are the changes allowed? Right? Like, I mean, if you're in the middle of a loan and you're allowed to say, oh, I'm calling it company sourced now, or, oh, I'm calling it self-sourced now, you're going to change midstream. I mean, it either was self-sourced or company sourced. So why 2 weeks from closing are you changing it? And if you're able to do that all the time with lots of loans, and then it just correlates to price changes at the same time, it doesn't take a rocket scientist to figure out what happened there, right? That's going to put you at risk. Now, how about something where you're only allowed to change it at the very beginning of the loan, or not change it? I'm sorry, you're only allowed to set it. You set it and it's done. Or if there immediately is a change because somebody clicked the wrong button, right? Some very, very limited circumstance approved. But you have a level of control over it at the outset, it can't change really. Then, I mean, you at least have some legitimacy around it. That legitimacy increases dramatically if you're actually able to show a distinction between these. So, for example, let's say, and this is to me where it's absolutely safe, is a scenario where, for example, you're buying leads and you can correlate back to those leads, the ones that are company sourced, and everything that isn't those leads is self-sourced. Something like that, yeah, because you can go back and check and verify this was a lead we sent you, so you're paid differently on it. I think that's totally fine. So, there's obviously a spectrum here we're talking about, right? But I think, closer to the latter I've explained is where you really want to be. And I would, strongly caution people to stay away from a scenario where, it's wink, wink, nod, nod, and everything's changed, because it's going to be easy to prove, right? All you have to do is look at the changes, especially if they're midstream. If they correlate to pricing changes, it's proxy, right? We all know that. So, I mean, don't sort of kind of kid yourself on that, right? It's easy to get caught on that. So be conscious of those practices. The things that I think you can't do, even though people want to, compensation redactions to match competition. To be clear, you can certainly reduce your pricing to match competition. Absolutely, no question about it, no concerns, but you can't reduce the compensation. So, I mean, yeah, you can absolutely match your competitors, just can't change the comp. Sham internal referrals. I kind of referred that, where you say we're going to transfer it, but you really don't. I think that's something that's clearly out of bounds. The other thing I would say that is really dangerous is the non-producers that actually originate. And I've seen this a lot of times where people come in and say, oh, I'm a non-producer, I could be paid on profit. And I say, okay, what's your name? And they tell me their name is, Tom Smith, right? And I go along, and by the way, not a real Tom Smith, just using two common names to be clear. And you go online and you look up the person's name and you see Tom there saying, hi, call me for a mortgage loan. Clearly originating, right? And remember in this area that some loan officers still view origination as signing the 1003. And it's much broader than that. So if I bring in the business, I talk to the customer, I, help them find the loan scenario that works for them, and then I refer them off to somebody else. I'm originating, I'm not non-producing. The simple fact that my name doesn't go on the 1003 doesn't make me a non-producer. It's the actions that led to that. So you have to really understand what originating is. And the thing is, it is so easy to get caught. And more importantly, we talked about the states stepping back on some of these things, not on that, right? Because that's an area that is very easy for them. And a lot of non-producers don't have their licenses anymore. So you also get into the scenario where you're talking about unlicensed activity. On top of that, if it is found to be a violation, the risks are enormous because every loan in that branch essentially violated the rule. And when you sold it to an investor or the government insured it, and you certified that you were in compliance, you've got a lot of problems there potentially at that branch. So I would really stay away from those non-producers and that's not to say there are not, to be clear, some legitimate non-producers, because they can exist. But you've got to be really clear that it's legitimate and that it's not somebody just tagging a title their name as non-producing so they can get paid the way they want to. If so, you're going to have a lot of risk. Next slide, please. Um, so how do you deal with this from a perspective of, one of your loan officers comes to you and says to you, well, this other company does this. I think you want to point out that individual loan officers have risks too, right? And if somebody's really over their skis on things, in theory, that can become a risk to that loan officer. Now, what's the reality of somebody actually coming after the LO? Probably pretty low, let's be honest. I mean, if a company has all these plans in place and is doing all these things wrong, no one's going after the loan officer, they're going after the company, and that would probably include the regulators. But I think, when talking to that loan officer, you can certainly point that out. The other thing is, when we talked about those adjustable plans before and having adjustments, if you have, let's say, 3 or 4 pricing plans that have with them compensation and you're, consistently, keeping people in those plans, giving the loan officer the choice. I mean, the reality is this: look, if you want to be 150 basis point loan officer or 200 basis point loan officer, whatever it is, you've got to perform at that level. And if you're not performing at that level and somebody's willing to pay you for performing at a level you're not performing at, the question is for how long? Because it's probably not continue all along, right? These agreements aren't infinite forever. So, what are you really getting? I mean, you've got to look at your performance and see what it is. I think that's a conversation that's useful. Another thing is to think about bonus programs, with retention incentives like golden handcuffs. And, what I'm talking about there is, just to be clear, is a comp program where, for example, somebody says, okay, let's say I were to say to you, next April, you're going to get a bonus of an extra 15 basis points on all your production if you're employed next April. And that'll be paid, next April. And so for the entire year, you're creating this 15 basis point bonus for yourself that's going to be paid next April. And that starts, by the way, every January. So it's calculated from January to January and paid in April. So let's think about that. So I wait till next April and I say I'm going to leave. Well, when I'm leaving, though, I've already built up from January to April my next bonus. And if I've had a really good first quarter, I don't really want to leave, right? Because now I've got this 15 basis points on all the volume I've done in the first quarter, right? And you could time this out to different quarters. This is just an example. But the idea is that you have their sort of invested into it. By the time they get paid, they've already started their next sort of bonus that's in reserve, that hasn't vested yet, if you will. And that way, when they're paid, they're already incented to stay for the next paycheck, right? They're sort of never ahead. And something like that can be an attractive way to keep people on board because, the difference is if I just pay you a bonus, I say, stay till next year and I'll pay you $100,000. Second they get that check, they can leave. You bought them till that point, but not past. Something like this is always kind of keeping them behind, but giving them a bonus and a reason to stay, if that makes any sense. So that's something that I would think about also to try to keep people, keep your retention up. Next slide. So let's talk about now another thing that we're seeing a lot of is the dual employment of real estate and real estate agents and loan officers where they're dually employed. So it's a real estate agent who's also a loan officer. I call them relos just for short. I don't want to go too deep into it, but just a very high level. Look, this is how I would generally, and again, if you want to do this, this is something I would suggest you talk to counsel about, but I'll give you sort of the general framework. Don't go and just do this though without talking to somebody. So generally speaking, I think you should have them outside sales. They should be listed part-time. Absolutely get them licensed. Give them very specific duties. Okay. Team them up with a loan officer. Well, let's start there. Okay. Those kind of first ones I've talked about in the slides. Let me tell you why I believe you should do that. So when you have a real estate agent who's also a mortgage loan officer, right? Are they going to be working from the office? And now if they are working from the office under the FLSA or state laws, you have to pay them a minimum wage and overtime. The question then becomes, when are they working as a real estate agent and when are they working as a loan officer? Now, you might be able to theoretically say, though, that's easy, but it's not. Because when I'm taking as a real estate agent, my client to look at a house and they're looking at the bedrooms and commenting on the carpet, and you say, hey, do you have a lender? Oh, no, we haven't looked at that. Well, I could, and the rest goes on. Well, when did you stop working as a real estate agent and when did you start working as a lender? Impossible, right? No one's ever going to be able to figure that out. I mean, they're totally over. Because think about it, when you were first meeting them, if you were going to ask about the mortgage, even though you're taking them to the house and driving, which one were you doing that, right? There's just too much overlap. So I think keeping them in outside sales avoids having to pay them on an hourly basis, which I think is almost impossible. Also, remember, you're going to have to get those real estate agents to start submitting timesheets. I mean, no way that's going to happen, right? You can't probably get your loan officers to do that. So, you're just adding on another level there. Now, why do I say part-time? Well, the other thing is this, with benefits, thinking about like health insurance and specifically, if you tell somebody under ERISA that they have health benefits and then the insurance company says they don't because, for example, the health insurance says to qualify, you've got to work 40 hours a week or 32 hours a week and be full-time, and you can't substantiate that they did that. The last thing you want to do is have promised them that, because then what happens is if they lose their benefits, you're on the hook because you promised it to them, right? So you could sort of override what the insurance does and have your own liability. And on the other hand, let's say they do qualify and you tell them they're not. You can have a liability there for interfering with their right to benefits. Now, if you have them part-time with the acknowledgement that I don't get benefits because I don't meet the standards for insurance because I'm part-time, and they waive everything, you're good. So outside sales and part-time keeps you safe on the benefits. And remember, I mean, think about this. If you look liability for health insurance, it's not the premium, right? It's the coverage. So if you promise somebody health insurance, don't give it to them, and they end up with some terrible disease with $1 million of, bills, guess whose problem that is? It's yours. I've dealt with that. So be really careful of that. Having them licensed and having actual duties. Well, the reason why I think this is important is that, remember something, I may be saying this wrong. My recollection of the case, the name of the case was Meridian Title. This was like 2014, 2015. The CFPB came into a title company and said, hey, if you have this, the title company sold or paid commissions to people that they said were W-2 employees for, selling, I guess, title work. And the CFPB came in and said, these aren't W-2 employees. These are really employees of another company that you just paid these referral payments to and called them a W-2. But under the economic realities test, they're not really employees. You've got to worry about that. That precedent is established. It's happened. They can cite to it, right? And so if you have somebody who's just really sending you referrals and you're not treating them as an employee in any other way, right? The economic realities of the relationship are just a referral. You can't just call them an employee and pay them, right? That's going to be blown up if somebody gets their hands on it. If they're licensed, if they have specific duties on a loan, if they're the, that they have to engage in on every single transaction, and they do, if they're teamed up with another loan officer, I'll talk to you about that in a minute, you're establishing the economic realities of real employment. And that's super important because number one, RESPA does not prohibit payments to employees, actual employees. It does to, contractors and people who are not employees. The other thing is that, if they have actual duties, they've done something on that loan, right? So if what I have to do is I've got to, going back to that, like, remember that old school 5 of 8 things that the realtor would have to do to get, this is back in the day. Look back at that, take some of those duties, maybe it's gathering stuff from the borrower or keeping the borrower up to date or going to the closing or whatever it might be. Have them be responsible in every loan because that gives you a double benefit. Not only are you showing economic realities of employment, you're also showing they actually did something on that loan. So the whole, you just refer to me, you're sort of double protected on that. The reason I say also team them up with other loan officers is remember these realtors they haven't done this before. They're not really trained. And this goes back to also the licensing. When you have somebody who really is just giving referral fees, they don't know what they're doing and they don't really care. Again, sorry to paint it with a broad brush, but I'm being real. And, I've seen some pretty bad things happen because of that lack of awareness. Realtors commonly do things where they say to people, okay, I'm really confident my buyer is going to be able to qualify because, they're a great guy and they've got a great lender and blah, 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 right? And so you should take my guy in this bidding war because he's going to be able to close or she's going to be able to close. And the next thing, the person doesn't qualify. Now, if they're just a realtor, no problem for you, right? They weren't your employee. I don't care what they said. They could say whatever they want. Now they're a relo. You don't get to play that game anymore because the person who heard that, the seller, well, was this person speaking as a realtor or were they speaking as a loan officer? It doesn't matter what your relo thought they were. It's what the person who heard it thought. And if they can make an argument that this person was acting under the authority of, clothed with your authority, so to speak, you've got a problem now. And if they're just out doing their own thing and you don't team them up with loan officers, you could see a lot of problems, not because they're trying to do something wrong. They're just not aware. I saw one recently where somebody put on an MLS listing. You must apply with me first if you want to submit a bid on this house. Required use, right? And it's in writing. Like there's no defense in that. You're done. So, you've got to really make sure they're working with somebody who knows these rules and can kind of keep them in line. One of the things, do not use the same agreement as you do with other LOs. You've got to establish the distinctions between this relationship, part-time, things like that they're employed as realtors. You need that all. And you also need to make sure things that are in your agreement for LOs aren't there. Like what if you use the same agreement and you promise them benefits, but you don't give them benefits? That could be $1 million plus mistake right there on the wrong person, on one person, right? So don't use those same agreements. Whatever you do, spend a few $1,000s. It's not that expensive to get these agreements done right for the right people, create the distinctions you need to create. It gives you all this protection and you should be okay. But you can set it up the right way. You can set up the wrong way. This one is a really easy way to do wrong unless you know what you're doing. Do it the right way. It's a few $1,000s and you get it set up correct and you don't have to worry about it anymore. So yeah, that's important. And also, of course, having these people trained so they don't inadvertently make mistakes like the ones I've talked about. Next slide, please. The other thing here is, this is what I'm seeing a lot. People say, hey, I don't want to have my person licensed. They don't want to get licensed. I mean, look, I'm not a big fan of that, I'll be honest, because I think if you've got somebody who's not committed enough to know the rules, you can imagine what might happen when they start working under, again, clothed with your authority. But the other thing is, how are they going to one of the reasons I've seen is like, they're going to be a non-producing branch manager. Okay, so I know that in the lab experiment, theoretically, that's great. Let's be real world now. Someone asks you a question, how are they going to oversee other LOs if they don't know how this works? They've never been trained, they don't have a license, and they have no experience. And you put them in charge of everybody? Does that sound a little weird? Because I will tell you, most people would think it is, right? I'm going to hire a completely inexperienced person with no training, no license, no no skill set that's demonstrable, and I'm going to have them run a branch. It's going to be hard to pull that one off. And the reality is, what's going to happen, right? Today, tomorrow, I mean, how are you going to establish those economic realities that they're actually doing something for all the money they're making? What activities are they actually engaged in? How are you going to prove they actually did it? I mean, I can write up a pretty document, right? But if they don't do it, the problem is even worse, right? Because you have this agreement that says you're going to do A and B and C and D. Did you do any of those? No, right? Because you won't be able to prove they did it. They didn't do it. And now you've almost created your own liability, right? Because what you've said is, well, the person to get paid had to do 1, 2, 3, 4, and 5. They didn't do 1, 2, 3, or 4, and 5, but you kept them employed anyhow, right? And you kept paying them anyhow, right? I mean, you're not probably winning that case, right? I mean, it's pretty obvious what was happening. And so creating those sort of documents that no one's ever going to live up to, in a way, it just creates your own liability because you've set the standard. And when they don't achieve it and you don't comply with it, it's pretty clear there was something else going on. And that's going to create a real risk for you. So, that's something I would really say stay away from. Next slide. Now, this one is a little better, like if they're a business development employee. So this is somebody who, let's say they would never deal with customers because they're not licensed, just as the non-producing person should either. But, they're reaching out to, and one point I'm sorry I want to make about the non-producing branch managers is if they start talking to customers, and it would apply to this too, you're going to have unlicensed activities, right? So if you had a business development employee who doesn't reach out to customers, they're calling, other real estate agents, they're calling builders, doing that kind of stuff. And you can establish that they're doing it. And I don't mean they've done it once and they have a relationship and so you're getting referrals for this. I'm saying that, they have 10 builders a week to call and meet. And they actually do this stuff and they're going out in the meeting and they're going for sales calls to these different developers and et cetera, et cetera, et cetera, right? In theory, that could work, right? But the key is they got to actually do it. If you create, again, a piece of paper to say this and you don't follow up to make sure they're doing it, you don't have any proof that they're doing it, you can't show that they brought new people online. And all that's happening is they're, two friends who are builders keep referring business. That's going to be a little bit difficult to maintain that relationship because that's starting to look more like a referral fee, right? So you've got to make sure they do it. But if you set it up the right way and if you policed it and if they actually did the things they were supposed to do, and again, does not involve contacting customers at all, maybe that could work. I will tell you though, I'm skeptical because I think most people who do this are doing it as a wink and a nod, and that's going to be self-evident over a short period of time. But again, if, in theory, that might be something you could do. But you're going to have to really police it to be able to establish they're actually doing something for this job. It isn't just getting referrals. They're out and they're trying to get new relationships, and you're expecting them to do that. And you hold them accountable to, some type of how many calls every week, who did you meet with, that type of documentation to establish their actual actions. Then maybe there's something you've got there, but they've got to actually do it. Next slide. Can you recruit? I mean, we're running out of time. So the bottom line is that, we'll go through all these details, so we'll leave some time for questions, but you can have recruiting incentives. And what I mean by that is have, recruiters out there or have loan officers who are getting a bonus to recruit somebody underneath them, be conscious. You could even have a realtor paid as a recruiter. The key is on any of that stuff, right? They're paid to recruit, not paid to send loans. So in other words, they shouldn't get payment on loans that they refer. If I was a realtor and I recruited and I got a bonus for recruiting, that bonus should not include payments on loans that I, as the realtor, refer to that loan officer. So it's not just a referral fee that's masked. They can get, a bonus on all the other loans that everybody else does and sends to them. So if you send over this really good LO that happens to also have a relationship, they get paid on all that money as a recruiter, right? Consistent with what you'd paid a recruiter. And, you could set something up. If you do, by the way, use recruiters, be really careful of the non-solicitation restrictions you put on or don't put on them. Because one thing I found is that when a recruiter leaves and doesn't have the right type of restriction, you leased those employees, right? You didn't, if you know what I mean, a lot of those people are going to leave with the recruiter when the recruiter goes somewhere else. So always really think about how you be very thoughtful how you set up the non-solicitation restrictions for recruiters post-employment. It's a super important thing because you've paid the money for those people to be there. You don't want to lose them the second the recruiter leaves. So I think I've hit most of the highlights here. I do want to leave some time for questions. So if there are any, I'd be happy to take them. And so I'm sorry, I can't see any though on the presentation. I can't see the questions. So if there are any, if you could let me know, that'd be great.
It's not showing on my screen either, Ari, at this stage.
Okay. All right. Well, then I think we are done, and I appreciate everyone's attention. I hope you guys found this helpful.